Alright guys, let's talk about what is going on with AMC, what's happening in the broad markets. As you can see, the VIX is up 2.5% today, and the NASDAQ and the Dow are up almost 0.5%. This should not be happening. As you guys probably know, the VIX is the volatility gauge. It measures the fear in the S&P 500 option. So when there's a lot of puts going through, the VIX goes up. When there's a lot of calls going through, the VIX goes down. Now, usually this correlates to what the broad markets are doing, meaning if the markets are green like they are today, the VIX should be red. If the markets are red, then the VIX should be green. Not green markets, green VIX. And the reason I'm pointing this out is because the VIX is up 2.5% today. That is a really weird correlation that's going on. The VIX is up more than the S&P 500. So what's exactly going on? Well, it looks like the markets are getting a little bit toppy, and what is actually happening with AMC stock and how this information pertains directly to AMC, well, AMC is still in a very bullish pattern, and what we have seen sometimes throughout 2022 is when you get red days, when you get the markets moving money around and going from sector to sector. At one point it was healthcare, at one point it was shorting banks, one point it was momentum stocks, right? Well, some of that money can make its way back into AMC stock, which I want to talk to you guys about that right here and right now in this video. So let's get straight into it. Like I said, VIX up 2.5%. It looks to me like this is happening because we are approaching the 200-day moving average on the S&P 500. Currently, the SPY is trading at 428.51, and the major moving average is at 429.23. So what that means is this is the 200-day moving average. If we break above this 200-day moving average and find more momentum, well, that's probably going to turn into a solid support level, and the bear market is over. That would essentially be a bull market at that point. We're breaking above our long-term 200-day moving average. We really haven't been above this for a brief period back in March, but we haven't been above this in 5 months. So if you break above that moving average, you're probably going to get a lot more momentum to the upside, or it becomes a major resistance level. Like we have seen throughout the day, the markets hit a high of 429.02 on the S&P, and the markets fell directly after that. It looks like it will be some resistance. And why I'm pointing this out is not necessarily because retail investors or even hedge funds that actively manage their portfolios are going to start selling stocks at the 200-day moving average. Not necessarily the case. But as you guys know, what controls the markets are the trading algorithms. Now, we could speculate what the algorithms have in store for the 200-day moving average. They're likely already being programmed, or they already have been programmed to either sell stocks off in a big way or to start aggressively buying stocks above the 200-day moving average. So that's why I'm calling it out, is because by tomorrow, you will see a break, if not by the end of the day today. You will see a break above the 200-day moving average, or confirm that this will be resistance and potentially this was all a bear market rally. It's hard to say that's the case, considering this has been the most aggressive rally, and even to a certain degree more aggressive than the COVID recovery. It seems like something has changed in the markets. It seems like people are more bullish now, but in all reality, ask yourself, what is actually changed? The consumer is still slowing down. Inflation is still 8.5%. The Fed is still raising rates. You still have global tensions. You still have Europe in a gas and energy crisis. So what has changed? Well, at the last Fed meeting, Fed Jerome Powell said, inevitably, like, this is common sense. Let's just put our common sense hats on here, and maybe that's the Budweiser cowboy hat. Put on our common sense hats here. Eventually the Fed was going to slow down. So that was not, shouldn't have been, I'll say that, shouldn't have been new information. The markets took that as the Fed is going to slow down right away. The Fed is going to stop raising rates. But the Fed said very clearly that it all depends on the data. Now, on one hand, the Fed doesn't want the markets to crash, but on the other hand, they don't want the markets to go up 20% in a month, right? that loosens financial conditions. That creates more capital, easy to borrow capital. And that creates more inflation. And that's the last thing the Fed wants to do. After all, the reason commodities have went down so much is because all of that fear about a recession that we had really starts to get commodities. It starts to get just anything that is inflationary starts to come down in anticipation of a recession. Now, if you don't get that recession and you don't teeter along that line of, hey, are we going into recession? Are we not? Are we not? Well, that's when you can start to see those commodity prices, energy prices, basically everything that is inflationary start to go back up, especially when you get a 20% rally in a month and a half. It's not what the Fed wanted. And what actually caused that was Fed Jerome Powell's comments, like I said, but that was an unscripted comment. So that was not in the Fed script. And Powell, he might have messed up by saying that. So I think these Fed speakers throughout the rest of this week will be very, very important, as well as the FOMC minutes and the retail sales. The retail sales month over month for July comes out at 8:30 in the morning on Wednesday. You have Fed Bowman that speaks at 9:30 a.m. and you also have the FOMC minutes at 2 p.m. Now, with these Fed speakers, I think it's very important to point out that they have been very hawkish. They have basically said they're nowhere near done raising rates, but the markets have literally blew all of them off. So it might take Fed Jerome Powell himself coming out some point this week or next week and talking the markets down, saying some pretty bearish things just to get the markets back in line, because the markets as of right now, it's like a train full steam ahead. You can't stop, won't stop. Buy stocks, you know, that's how the markets are feeling right now. You might need Fed Jerome Powell himself to come out and reiterate that, yeah, that's not what I meant, that we were going to stop raising rates right away. They might come out and start to say, yeah, maybe halfway through 2023. At that point, is this rally justified? Well, probably not. At the same time, the PE ratio for the S&P 500 is back over 19 historically, even back to the 2008 crash, back to 2018, 2019, 2020. All these crashes that we've seen was when the S&P 500 price to earnings ratio went over 19. So even historically speaking, we're overvalued, and that's not because individual stocks by and large are overvalued. A lot of individual stocks are actually undervalued, but it's due to the weighting of the S&P, where Apple is over 7% of the S&P, Microsoft over 5% of the S&P. When you have these kind of market weightings, it doesn't matter what individual stocks are valued at necessarily. It matters what the big guys are valued at. When Apple's valued at a 28, 29, 30 PE, Microsoft sitting about the same at around a 27 to 30 PE. You know, Amazon at a 25, Google at a 27, right? Of course, you're going to average out to a 19 PE or more. Not to say the markets have to come down because of that, but it's not a positive thing whatsoever that valuations are so stretched. It's kind of ironic because 2022 has really been the year of valuations don't matter. To the downside, valuations don't matter. People didn't want to buy stocks, and to the upside, valuations surely don't matter, and people are buying stocks. And by people, I mean mostly the trading algorithms. So I don't think valuations are really a big deal for the algorithms right now. Obviously, for your long-term thesis and your portfolio, they should be a big deal. And all I'm trying to say here is you really want to be careful. I don't think this is the time to really load up and buy the dip if you have not already. I think you will have much better buying opportunities. But then again, I have been saying throughout basically all of 2022, especially through May and up until, you know, the beginning part of July, really that whole market sell-off, that I was pounding the table that was the time to buy the dip. Buying the dip now seems counterintuitive considering you have rallied so aggressively and so hard over the last couple of weeks. Even if you look at something like Apple, Apple is the new meme stock. the new momentum stock. It's been vertical. It's been straight up. You didn't even recover like this certainly during the crash of 2020, and you haven't seen anything like this in recent history for Apple. You probably have to go back a very long time to get a parabolic rally in the same way that we have been seeing as of lately. Apple almost at a brand new all-time high. So when you mix this all together, you're probably in for some more downside. Specifically with AMC, we're holding above $24 per share at the time of recording this video, and we are well above the 200-day moving average at $20.59 per share. Now, like I mentioned earlier in the video, that you start to get money moving around to different segments, and what I have heard from some financial analysts, from some hedge fund managers, is that momentum stocks such as AMC might turn into be a, September, October, November, December kind of safe haven when you have these midterm elections, when you have the Fed pounding the table, raising rates even more aggressively. People might flock to the momentum stocks because what have we seen over the past month or two? Well, they have been performing very, very well. AMC is right behind Carvana in the top Russell 3000 performing stocks. So, and AMC is actually second. It has rallied over 100% from the lows that we have seen, well over 100%. So has Carvana. So I think to a certain degree, these momentum stocks such as AMC could become somewhat of a rush to safety. Now, for tomorrow, you do have earnings such as Walmart and Home Depot in pre-market, and then you have Target, Lowe's, TJ Maxx for Wednesday in pre-market, and I think these guys are going to be a very big catalyst. It's going to tell you how people are spending their money, if they are buying discretionary items, or if it's really just concentrated in food and gasoline. So I think that will be very, very key. Now, in regards specifically to AMC and the data that you guys need to know, beyond even a technical basis, and before we get into that, I do want to show you guys that the RSI on the S&P 500 is now overbought. You have not been overbought on the S&P 500 since back here November 5th of 2021. So almost 1 year you have not been overbought. And now we are firmly overbought here today on the S&P 500, and we were actually overbought on Friday as well. So you are now 2 days into the S&P 500 being overbought, meaning this rally might have some legs to it, or it might be, well overdone at this current moment in time. I'll let you guys make your decision on that and let me know down below in the comments what you do think. But in regards to AMC stock, the option activity, 74 orders for the day, totaling $12.33 million, positive order value of 79%. So looking very bullish in regards to option activity. As far as the short interest, you're sitting at $2.24 billion worth of short positions. That is a large amount of shorts on AMC stock. Imagine those sweet tendies making their way to our portfolios, baby. It's only a time game at this point. We know the trade, we know the data, but nonetheless, the estimated short interest of free float is 17.78%. Free float out on loan 26%. Shares out on loan 134 million. Days covered 2.84. Cost to borrow 8.84 and 100% share utilization. Cost to borrow max at 10.49% and cost to borrow average at 8.33%. Cost to borrow minimum at 7.26%. A brief look at some more of the technicals on AMC stock, just because, hey, why not? Volume has remained a little bit higher for the day, a little bit lower, currently sitting at about 36.4 million shares that have traded hands. The RSI is now below 70, indicating it's more in line with a normal range. It's not overbought as of today. The MACD still incredibly bullish, so that is showing me some good momentum with the MACD and a healthy relaxation of the RSI. Now, the key level you want to watch, like I said, 200-day moving average for support at $20.59 per share. The key level to the upside, really, you want to watch around $25 per share, see if we can get a close above that possibly tomorrow. And then you definitely want to watch that $30 level. That is going to be key. And then ultimately above that, $35 per share. If we can get up to those levels, then you might start to see some even bigger moves. So that is pretty much going to be all for this video. That's what you guys need to know in a nutshell. Hit that like button and subscribe to the channel. Come join the trading community if you guys want to be a part of that. Link down below in the description. And if you guys want to get free stock, Webull, Moomoo, and Public down below in the description. You will find links for those as well. Take advantage of that. Get yourself that free money. Nonetheless, you guys enjoy the rest of your day, and I will see you in the next one.